So this was one thing that's being put out there, right, to kind of scare people right now. Goldman Sachs says the Treasury Department will have to quickly raise $1 trillion if and when the debt ceiling is approved. Liquidity will be drained from the market to purchase these treasuries, right? And always something to try to scare retail. It's just, that's what it feels like. There's always something like, oh my gosh, this, right? I hope that happens. Like, as somebody that buys stocks every single week, please send the market down. Begging you. And so isn't everybody that's way off sides right now begging for the market to go down, okay? Is there anything going to happen there? Probably not. But if there is, I'll be happy. I'll be happy buyer, okay? Send the market down. Please do it. Saw this out there, right? Such a bad take. Such a bad take, okay? So, this person, and obviously this type of stuff that gets headlines, and if you're not very educated on financial markets, on how to value companies, you look at something like this, and if you don't have much experience, you're like, oh my gosh, yeah, this is crazy. Oh, price to sales ratios, look at this. This is insane. Look at the S&P 500. Look at NVIDIA, 215. You go crazy, right? Oh, price to sales ratios, oh my gosh. Oh my gosh. Freaking out, right? It's not how you do this game whatsoever, okay? Price to sales ratios, comparing price to sales ratios across the stock market is one of the most delusional, silliest things you could ever do. Ever. It makes 0% sense to compare S&P 500s for different stocks in different industries and sectors. It's not how this game works. Different sectors, different industries deserve much different valuations than other ones, okay? A SaaS business is going to command a very different price to sales ratio than a retailer, for instance. Why? Because their profit margins are immensely different. Their net margins are immensely different, okay? A good example of this is Macy's, okay? Macy's, the retailer that's in your local mall, okay? Their price to sales ratios are usually anywhere from 0.1 to 0.3, right? So you can say, oh my gosh, Macy's has got to be the greatest deal ever because, good, look, price to sales ratio S&P 500 is 2.4. Macy's at 0.1, 0.2. Oh my gosh, it's got to be the greatest deal ever, right? And you can run with all these conclusions in your mind. It's not how this works. It's not how this works, okay? Retailers command very low price to sales ratios because their margins are razor thin, right? And so that's not the way to look at this. The only time to look at price to sales ratios is if you're comparing within the same industry with the companies having roughly the same growth rates, okay? So let's say I want to buy a retailer, right? And so I'm looking and I'm like, I'm thinking about either Nordstrom, Kohl's, or Macy's, okay? Let's say that was my thought process. Well, I could go ahead and I could look at the price to sales ratios of all those companies and say, okay, Nordstrom trades at a blah, blah, blah. Price to sales ratio, Kohl's at a blah, blah, blah. Macy's at a blah, 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 right? And I can look at the forward Ps, and maybe the forward Ps are roughly the same. So, I look at the business models, and then I'm like, you know what? I think this one's a little better because the price to sales ratio is 0.1 versus this other one's 0.2, and this other one's 0.25. If you want to compare it a little bit that way, there you go. There you go, okay? But in terms of looking at price to sales ratio, that's the only time it's relevant. When you're looking at inside very specific stocks that are roughly viewed as the same type of companies, right? If you wanted to look at Walmart versus Target and you want to compare them on a price to sales ratio, do it. That's perfectly fine. But to compare Walmart's price to sales ratio versus Salesforce's price to sales ratio versus Apple's price to sales ratio versus, Shopify's price to sales ratio, it makes no sense, okay? Always remember that. That was a very important point I just gave out there to everybody, okay? That's a free gem for you. Boom. There you go. Okay, one of the pushbacks from Palantir you hear sometimes is their product's very expensive, right? Companies can spend 8 figures on Palantir's products, 9 figures on Palantir's products, right? At the end of the day, whenever you are a business and you're spending money on anything, the bottom line is, does that specific product help you at least generate that money back, if not a lot more, right, in terms of revenue, or save you and have you make much better decisions that then lead to a greater value than the $50 million you spent on the product? It's as simple as that. And so for, let's call it a company that has $5 billion in revenues, so all they care about is that whatever they spend with Palantir, that they're going to get more out of that. It's all you have to do. It's a very simple game when you break it down on the most simplistic level here. And that's something that obviously I think customers sound like they're really excited that Palantir is going to be able to deliver them. PayPal. PYPL, okay? PayPal stock is about $60, a little over $60 a share right now. It's the easiest money I've seen in the market since Meta in the fourth quarter of 2022. You know, when this stock dropped to $100, it was like, how? How could this stock be at $100? Then when it dropped to 60, it's just like laughable. It reminds me a lot of Meta in the sense of like when Meta dropped under 150, it's like, this is insane. Like, how is this happening? And then when it dropped under 100, it's just like, you got to load it with both hands. And that's exactly how I feel about PayPal right now. Okay. And we'll talk about why the stock's actually down so substantially, because it's not the numbers. I can tell you that the numbers are tremendous. Okay. Now, when you buy PayPal, there's a few things you got to understand. You're getting PayPal, right? You're also getting Venmo. PayPal and Venmo, I say most people watching this video right now, you have either PayPal or Venmo downloaded on your smartphone. You might even have both of them. Okay. I know certainly I do. Two of the most popular apps in the finance-related space, right? Always. But the business that's hidden with PayPal that not a lot of people see or know about unless you really dive in deep here is a beast business. And this is called Braintree, okay? Braintree it's not like some type of app, you download that everybody that's an average person out there uses. This helps companies run transactions on their back end, okay? And the thing that's really exciting about Braintree is they do it all seamlessly where you can pay with PayPal, you can pay with Venmo, you can pay with credit cards, debit cards, you can pay with Apple Pay, Google Pay, all in one spot, which is beautiful because I can guarantee you a lot of you guys have wanted to pay with a certain way and you weren't able to pay with that certain way in the past, right? Maybe you wanted to pay with Apple Pay or Google Pay or you want to pay with PayPal or something and you haven't had that opportunity. Braintree allows you to be able to pay with anything, okay? In terms of the companies that are working with them, they're working with a lot of big dog companies now, okay? Airbnb, Yelp, GitHub, Dropbox, Honest. Man, at least somebody's making some money from Honest, right? Six Flags, Grubhub, PagerDuty, Basecamp, Stitch Fix. It's incredible, okay? OpenTable, StubHub. I mean, the amount of times you probably have used Braintree and just not realized it because, you're just using a, payment processor and you don't realize it is immense, right? Uber. I mean, it's incredible how many different big companies this company's working with, and I just see it being more and more, right? Because there's more and more of a need to have all these different services because so many people want to pay different ways, right? And I think if anything, that's going to get bigger. The fascinating thing is in 2012, Braintree was actually acquired Venmo for $26 million, right? And then obviously, PayPal bought it then, and that's back when PayPal and eBay were together, and then eBay split into its own thing, and then PayPal became its own thing with Braintree and Venmo, right? But it's crazy to think that Braintree actually was the ones that acquired Venmo in the first place, right? Now, in terms of the most recent numbers, and keep in mind, this is in a kind of a tougher economic environment. These are incredible numbers. Total payment volume grew 10%, 12% on an FX neutral basis. GAAP operating income came in at $1 billion. That grew 41%. Oh my gosh. Non-GAAP operating income was up 19%. GAAP EPS grew to 70 cents compared to 43 cents. That's a 61% growth. Non-GAAP EPS grew 33%. Free cash flow came in at $1 billion. Operating free cash flow came in at $1.2 billion, right? I mean, the numbers are incredible. This stock is not down because of the numbers. I can tell you that much. We'll go through that in just a moment. And it's not down because of valuation, because the valuation is dirt cheap on this company. I'll show you that in just a moment, okay? Now, they also just raised their EPS guidance for the year. Okay, fiscal year 2023 GAAP EPS now expected to be $3.42 compared to $2.09 last year. Non-GAAP EPS now expected to grow 20% to $4.95. Now, they're also doing a huge share buyback right now. So if anything, you should if you're a buyer of PayPal stock, root for the stock to be low for the rest of this year. One is, so obviously if you're a buyer, you want to buy the stock for cheaper, right? If you want to build this position over the next 3, 6, 9, 12 months, whatever. But also, the company's going to be able to buy a whole lot more shares back the lower the stock price is. So if anything, you kind of got to hope the stock price stays low. Now, why is the stock price down so much? Okay, it's not because of numbers, and it's certainly not because of valuation. I'll show you exactly why the stock is down immensely and why it's not going anywhere right now. Dan Schulman, president and CEO of the company, he's going to be stepping down of this company here at the end of the year. Okay, now they haven't found a new CEO yet, and so a lot of people on Wall Street they look at PayPal as a don't touch right now. They don't want to touch the stock because they're like, well, I don't know who the new CEO is going to be. I don't know if they're going to focus on revenue. I don't know if they're going to focus on net income. I don't know if they're going to try to focus on both. I don't know if they're going to try to split off businesses. I don't know what they're going to do, right? And also people are confused about who will be the future CFO of the company, right? Because a lot of times CEO changes, CFO changes. Like people are like, I don't know. And so a lot of people don't want to touch this right now. The moment a new CEO is announced and the vision's understood, right? Which could take a few months for them to explain the vision out there. That's when the stock starts to take off like a rocket ship, in my personal opinion. It could happen before then, but I think once there's clarity there, that's when people are going to feel much more comfortable, because then they'll know, like, oh, they're going to really just go after revenue. They're really going to go after net income in those sorts of things, right? The valuation is dirt cheap. I can't lose on this stock. I can't lose on this stock. I mean, the forward P is 12. 12 for PayPal? They're growing double digits. You know, they're going to grow EPS, what, 20%? I mean, for a company with these sorts of growth rates, I should be paying a minimum of a 24 P. But honestly, I should really be paying a 30 or 40. So that's why I don't think it's a stretch to imagine this stock goes up 100%, 200% in a short amount of time. When I say short amount of time, I mean in 1 to 2 years. If PayPal stock is 100% higher than it is today, even 200% higher than it is today, in 24 months from now, I will not be surprised at all. At all. The valuation is dirt cheap on this company, okay? So that's PayPal.